Hi everyone, welcome again to Learn with Debbie, and today's topic is adjusting entries, making sure your financial statements are accurate. Now imagine you paid 1 year's rent in advance. Let's take for instance you paid rent for 2 years, or your employees have worked for a month but you haven't paid them yet. It means you're owing them salaries for that month. Now, should your financial statement ignore these transactions? Of course not. That's why accountants prepare adjusting entries. You have to adjust all these things accordingly. What are adjusting entries? Adjusting entries are journal entries made at the end of an accounting period to ensure that revenues are recorded when they are earned and expenses are recorded when they are incurred. This follows the accrual principle of accounting. Revenues recorded when they are earned and expenses recorded when they are incurred. Now, it means for the example we gave of paying a year's rent in advance, it means you have paid for it, but you have not yet enjoyed that year. So, would you include it as the rent for the year? Of course not, because that expense is not meant for that year. Or the salaries. Your workers have earned that amount for the month, but they haven't been paid yet. Of course, you must include it as expenses for that month, even though they have not yet been paid, even though the money have not gone out yet, but that expense has already been incurred. So, it should be recorded as part of the expenses for the month. Now, why are adjusting entries important? Adjusting entries helps us to prepare accurate financial statements to make sure that every income earned for this period or every expense incurred for this period is captured in this period. It helps us to match revenue with related expenses. It will help you match revenue with related expenses. It also helps to avoid overstating or understating profits. When you do not capture expenses when they occur, it means you're overstating profit. Now, it also helps to ensure that assets and liabilities are reported correctly. These adjusting entries helps to make sure that everything is accurate, everything that pertains to a particular period of time is captured. Now, think of them as a final check before preparing financial statements. Now, look at some examples. An example on accrued expense. That's expense that you're owing. Now, our example, Debbie Supermarket. Imagine Debbie Supermarket employees have earned 800,000 naira in salaries, but they will be paid next week. Ask yourself what happened. Now, if we are preparing financial statements this week, let's say this week is end of the month, and we want to prepare financial statement for this week, for this month, this week, and then the salaries have not yet gone out, they will go out next week. We have to take note of this expense because it has already been incurred. They have already earned this amount, and so we have to capture it as part of the expenses for this month. Now ask yourself, what just happened? Salary expense increased, and what? Salary payable also increased, because although the expense has already been incurred, but then it has not been paid, so it is a payable. We are owing. Now, this is the treatment. You debit salary expense with the amount and you credit salaries payable with the same amount. Remember, expenses increase on the debit side while liabilities increase on the credit side. Now, another example, prepaid expense. Now, think about this. You are supposed to pay for electricity bill next month, but this month you paid for the electricity bill for 2 months. It means you're having a prepaid expense for what? Expense of next month means you capture 2 months expenses in a month. Then you have to take out the next month's expense because it cannot be captured as part of this month's expenses. Now let's take our example. The business paid 1,200 naira for 1 year's insurance. So at the end of the first month, 100 naira has been used. So we've already paid 1,200 naira. But then at the end of the first month, only 100 naira has been used. It means we still have a balance of 1,100 naira that we have not used. Now ask yourself, what happened? With this 100 naira, what happened? Our insurance expense increased and award prepaid insurance decrease. Remember, prepaid insurance will be like an asset to us. Now, what will you do? Debit insurance expense because our expense increase, and you also credit prepaid insurance. Remember, prepaid insurance will start like an asset to us. It's prepaid, it's an asset. We have not made the expense yet, but we have paid for it, so it's like for future. Now it is like an asset to us, so it will have a debit balance. So if it is reducing now, it will be on the credit side, which is why prepaid insurance is credited with 100 naira, because it is reducing the assets of prepaid insurance on the debit side. Now, common beginner mistake. Many beginners think that if cash hasn't moved, no journal entry is needed. No, not true. Some expenses and revenue must be recorded even when cash has not yet been received or paid. So it doesn't really matter if cash moves or not, as long as an income has been earned or an expense has been incurred, it has to be recorded, so the financial statements can be accurate and correct as at the date that it is being prepared. Now, a quick practice. A business owes employees 500,000 naira in wages at the end of the month. Now, what accounts are affected? Think about it. The answer is the wage expense account and the wages payable account. The wage expense account will increase on the debit side with the 500,000 amount, and wage payable will also increase on the credit side because it is a liability. Although it's an expense, but it is also a liability because it has not yet been paid. Now, what transaction will occur when it finally gets paid? Cash will reduce on the